Good evening, everyone. My name is Simon, and I'm the Chief Business Officer of MYTHEO, and welcome to our monthly performance review session. Thank you for joining us today. And today you'll be hearing from our Chief Investment Officer of MYTHEO, Matthew Stuart-Box. So we will be reviewing the performance of MYTHEO portfolio for March 2022, year to date, and how we have performed last year. Meanwhile, we will also discuss the portfolio rebalancing that have taken place last month as we try to deliver high-quality, risk-adjusted returns to our investors. Without further ado, over to you, Matthew.
That's great. Thank you very much, Simon. And thank you everybody for dialing in today. So as Simon said, we'll go through some of the most recent performance for MYTHEO. I'll talk through how we're positioned at the moment, and also some of the trades, some of the position changes that we've had in the portfolio recently. So if we start with the numbers, this shows our performance during March, and then also year to date and since the launch of MYTHEO. And there's a couple of things to mention here. If we look at the three main portfolios, the growth, income, and inflation hedge portfolios, they were all launched back in 2019. And since inception, they've all had positive performance. You can see the growth portfolio is up nearly 26%, income up just over 2%, and inflation hedge up also over 25%. Since launch. So all of the portfolios have been positive since launch. Obviously, when you look at individual time periods, some have done better than others. 2021 was a very strong, very good year for both the growth and the inflation hedge portfolios. The growth portfolio did very well obviously on the performance of global equities. And the inflation hedge portfolio did exactly what it's meant to do. It did well as inflation concerns returned. And then if we look at the performance year to date, growth and income have struggled so far year to date, down 4.5% and 4.8%. Whereas inflation hedge portfolio is up just over 1% year to date. And then today, I want to focus on the most recent performance, so for March 2022. So we'll go through the drivers of some of that performance and where each of the portfolios is positioned. Maybe if we start with the growth portfolio, just to recap, the goal of this portfolio is to provide a high return over the long term, a similar kind of level to the growth of the global equity market. And so this portfolio is based on a portfolio of equity ETFs, a wide range of ETFs, a diversified portfolio. And it's mostly suitable for people with a relatively long investment horizon and who are able to take an appropriate amount of risk from an equity portfolio. In March, the portfolio was up 1.23%. This slide shows the positioning of the portfolio. So maybe if we look on the left-hand side here, this shows the different ETFs that are in the portfolio at the moment. And so we have a total of 14 ETFs in the portfolio. The blue ones here are US and North America. And so they account for just over half of the total portfolio. And then we have just under 20% in Europe, so the UK, Germany, and Eurostoxx. Then just over 20% in Asia, Japan, Hong Kong, China. And then a small position, just under 3% in emerging markets and frontier markets. And then if we look at the drivers of the performance in March, it was mostly driven by this blue part, the North American part here. And so Canada, large cap US stocks performed well in March, a good rebound. And they were the main drivers of the positive performance. The European positions were roughly flat for March in terms of contribution to performance. And then most of the detractors were from the Asia positions. And so you can see large cap China was negative, Taiwan, Japan also negative. But overall, a good solid month, I think, for the growth portfolio. I think the key here is to keep it nicely diversified. You can see even within the US, we don't just invest in one generic US ETF. We invest in a range of market caps, large cap, mid cap, and a range of styles, value stocks, growth stocks, things like that. So even within the US market, we try to diversify the portfolio. So that's the growth portfolio for March. If we move on to the income portfolio, and so the goal of this portfolio is more to provide regular, high, stable levels of income with lower volatility than, for example, the growth portfolio. And so this portfolio tends to be concentrated more in fixed income, bond, ETFs, also high dividend equity ETFs, things like that. In March, the performance of the portfolio was negative, so it was down 2.65%. And if we look at how the portfolio is positioned, this shows the individual ETFs.
I just want to put for Mr. Gunn and Ronnie that as we go into Drop 2 and Drop 3, and we are all aware of what.
So this shows all of the ETFs in the portfolio. So the blue ones here are government ETFs, government bonds. So we have US Treasuries, international government bonds, things like that. Different maturities, of course, so spread out across there, but these blue ones are all government bonds. This kind of orangey brown part here, these are corporate bonds, high quality corporate bonds, so investment grade corporate bonds and mortgage-backed securities here. And then the green part here, these are higher yield ETF bonds. So these are relatively higher credit risk, but higher yielding bonds here. The performance here you can see is a minus 2.65% during the month. It was a tough month, I think, for all bond markets. You can see actually all of the ETFs in our universe were negative for the month. Obviously, in this kind of environment of rising inflation, rising interest rates in many markets around the world, this is a relatively tough environment for bond markets. In the case of our portfolio, the largest detractors were things like the US Treasury portfolio, where the rise in the US interest rate, the signaling from the US Fed of tightening over the next 2 years has naturally been negative for longer dated, especially longer dated bonds. The parts of the portfolio that did relatively well were some of these high yield ones where the investment horizon, the maturity of the bonds is relatively short, and so they're impacted less by higher interest rates. But overall, this was a negative month for the portfolio, and it's negative year to date. We also did a relatively large trade in this portfolio at the end of March. We turned over the portfolio about just over 20%. And so I'll explain a little bit about how that process works and what was involved in it. Just to recap, all of the MYTHEO portfolios are maintained automatically on behalf of our clients. So the clients don't need to do anything at all to keep their portfolios up to date. And this maintenance work runs on a monthly, a quarterly, and an annual cycle. You can see the various different steps here. Every month, we rebalance the portfolios back to their target allocation. And that just takes into account the market moves that have happened over the last month. And then every month or quarter, depending on the type of portfolio, we do what's called a reallocation where we use our proprietary models to re-optimize the portfolio and come up with a new set of target weights. And then annually, we update the portfolios for changes in market conditions and update the portfolios to reflect the increase in age of clients. And so for the income portfolio, we were doing a reallocation at the end of March. So it was this step here. You can see here we do this kind of reallocation for all of the functional portfolios. The growth portfolio and the income portfolio, we do this every 3 months. The inflation hedge portfolio, we do it every month. And end of March was part of the 3-month cycle for the income portfolio. So this is all driven by models. This is not driven by any kind of individual discretion by the portfolio manager. It's all driven off a regular cycle, and the reallocation is done based on our proprietary models. The outcome of the reallocation in March for the income fund was we increased the weight for several bonds. The most important one here is this short-term corporate bond fund. So this is investment grade, so it's high grade corporate bonds, and we increased the position here by just over 11%. So it's a relatively large purchase here. In terms of ones which we sold, decreased, we exited a couple of portfolios here, a couple of ETFs here, this intermediate government bond fund and this treasury fund. In particular, the 7 to 10-year treasury fund, we closed our position there. The overall impact of the reallocation was to shift the portfolio slightly away from treasuries and towards corporate bonds. They have a slightly higher yield, and they also have a slightly shorter duration, a slightly shorter term to maturity. And so these are probably a safer place to be in a rising interest rate environment. But this is all part of our regular process for managing these funds. There was no kind of exceptional override or anything like that. It's all part of the regular process for these portfolios. Next, we have the inflation hedge portfolio. To recap, the goal of this portfolio is to protect the real value of the assets in the portfolio. So it's to protect our investors from inflation, price rises. And obviously this is very pertinent right now. Yesterday, the US announced their most recent inflation figures. Inflation in the US over the last 12 months was 8.5%. We've seen a material spike in inflation in the US, signs of that in Europe too, as in other countries. The good thing is the inflation hedge portfolio is performing the way we hoped it would do in this kind of environment. So it's up 3.04% in March. If we look at the positioning of the portfolio, it's nicely diversified across a range of different assets. Up here, we have more commodity-based assets, things like metals, oil, gold itself. We also have a large position in various forms of real estate in the portfolio. Obviously, real estate is a very good long-run hedge against inflation. And so we have US real estate, including residential properties, commercial properties, offices, retail premises, things like that. But also global real estate, infrastructure, things like gas pipelines, energy infrastructure, that kind of stuff. That's a big part of the portfolio. And then this brown part here, these are TIPS. These are US Treasury bonds where the interest rate is linked to inflation. And so these provide you a very direct hedge for inflation. If inflation goes up, then the interest rate on the bonds goes up as well. So these are also a useful way of hedging inflation, especially in the short term. So it's a good diversified portfolio covering various different kinds of inflation hedging assets. So as I said, it had a very good year last year, and so far it's doing well this year as well. The drivers of the performance in March were mostly on the US real estate side. US real estate has rebounded very strongly, especially on kind of tight supply in the US market. And so the biggest contributors during the month were things like the US real estate, also oil as well, was positive for us. So those are the three main functional portfolios. I'll just briefly touch finally on our ESG portfolio. And so this is a portfolio of equity ETFs, which have exposure to global environmental, social, and governance principles. And so the goal of this portfolio is to provide a high long-run return, a similar kind of level of return to the growth portfolio through exposure to the global equity markets, but including exposure to high-quality ESG companies. So if you look at the composition of the portfolio, it's made up of 5 ETFs, 5 global ETFs, and they are all ESG-focused ETFs. So we have about 25% in Europe and Africa, about 25% in emerging market ESG, and then roughly 50% in various forms of US ESG, large cap value, large cap growth, things like that. Again, this portfolio was positive for March. It was up 0.53%. And similar to the growth portfolio, the biggest drivers here were the US parts of the portfolio. But again, it's a nicely diversified portfolio across a range of different regions. So that's a rundown of kind of how all of the portfolios are positioned and how they've been performing year to date and during March. I'll stop here for now, but I'm very happy to take any questions, any queries from any of our investors.
Yep. Matt. So we have a few questions here from our audience. So first question is, do MYTHEO invest in a single stock or all ETF?
Yeah. Okay, thank you. It's a very good question. The answer is we do not invest in single stocks. All of our portfolios are made from ETFs. And the simple reason there is, cost and efficiency. Buying individual stocks is a good way of building like a very focused active fund. But if you're looking for a well-diversified portfolio, you need to hold a large number of stocks to get diversification. And in that case, ETFs are the most efficient way of building a diversified portfolio with very low running costs. So MYTHEO is completely based on ETFs.
Sure. Okay, thanks. Second question is, why inflation portfolio review monthly while others are on quarterly basis?
Yes, that's a very good question. Yes, yeah. We found that the inflation portfolio, it's the model that we use for the inflation portfolio is slightly different from the growth and income portfolio in that it's trying to hedge inflation. So it's trying to match or at least match or hopefully beat inflation. And we found that in that case, it's more effective to reallocate the portfolio every month. In the case of the income portfolio and the growth portfolio, they're not trying to hedge anything particular. They're simply trying to achieve good long-run returns. So in that case, it doesn't make sense to reallocate very frequently because that simply generates a large number of trades, a large amount of trading costs. And so that we found that for those kind of portfolios, a 3-monthly cycle is more efficient. Whereas if you're trying to hedge something completely, then a monthly cycle is probably more efficient. But yeah, that's a very good question.
I see. Great. So another question is that mostly we are seeing decline year to date. does this actually signal a recession coming? So they've been reading a lot of recession or hearing a lot of recession news lately. So is it still advisable to invest at the moment?
Yeah, okay, that's a very good question. So if you look here year to date, well, two of our portfolios are negative year to date, the growth portfolio and the income portfolio, and one, the inflation hedge portfolio, is positive year to date. And you're right, there's a lot of commentary about recession. It's a stagflation word that it's quite common in terms of low growth and high inflation. And that's certainly a possibility. We can't deny it's a possibility with this spike in inflation, particularly in the US. Just to make it clear, global economic growth is very unlikely to be negative this year. For example, the IMF is predicting the global economy will grow by just over 4% this year. Even with the effect of the higher oil price and the conflict in Ukraine, it's highly unlikely that the global economy will fall into negative growth this year. Highly unlikely. Certainly, there are some countries that might fall into a recession, but it's highly unlikely that global economic growth will turn negative this year. There are very few economists who are predicting that at the moment. However, it's natural that for investors, rising inflation, rising interest rates are a source of concern. And we've seen higher volatility in markets, bigger swings, both negative and positive, over the last, 5-6 months. What I would say, though, is it is extremely difficult to time these kind of things. It's certainly possible that the equity markets might fall this year. It's also possible that they might rise this year. If you look back at, say, 2021, I would say that nobody at the start of 2021 was expecting the US equity market to be as strong as it was that year. Everybody at that point was still worried about the long-term effects of the pandemic. Nobody, I don't think, was expecting a 20+% return in US equities last year. And so the point is, it's extremely difficult to forecast global market returns. It may well turn out that the next couple of months are negative for various asset classes, but they might not be. If you choose to try and enter the market and leave the market and try and time these kind of ups and downs, it's not impossible, but it's an extremely difficult thing to do. We found that in our experience, the best way to generate long-term returns is to keep a stable, diversified portfolio, stay invested all the time, and don't worry about these kind of like shorter-term ups and downs. In the long run, equity markets will rise. In the long run, the income portfolio will generate good returns for you. Don't sweat too much about headlines, things like that.
Yep. Okay. One more question. Since you are bringing up this slide which shows that inflation hedge portfolio is positive. So is inflation hedge portfolio the way to go? It has seems to be the trend since last year as well. So would it be okay if I switch 100% to inflation hedge portfolio?
Yes. So within MYTHEO, of course, we provide every client with a recommended allocation, and that's based on our algorithm that looks at the individual needs of each investor and comes up with a target allocation. And those allocations are different for each investor. However, MYTHEO does allow you to tailor your portfolio. And if you want, you can put 100% of your portfolio into inflation hedge or 100% of your portfolio into growth or whatever. And that's perfectly okay. Each of these functional portfolios are designed to be perfectly valid standalone portfolios. And so if you choose to put, for example, all of your assets into inflation hedge, there's nothing wrong with that. You'll have a perfectly sensible portfolio, no problem at all. I can't give any recommendation as to whether that's a good thing to do or not, but if you choose to, you'll have a perfectly sensible portfolio, certainly.
Sure. Okay. So one more question. How do you benchmark MYTHEO's performance, and how would you rate the performance so far?
Yes. So we have internal benchmarks in terms of measuring performance of each of these functional portfolios. For example, the growth portfolio relative to global equity markets and things like that. I'd say, since inception, we're reasonably happy with the overall portfolio performance, especially if you look at the kind of like since launch returns. Those are very strong returns, I think. In terms of performance relative to our internal benchmarks, I would say the income portfolio and the inflation hedge portfolio have outperformed their internal benchmarks. The growth portfolio has slightly underperformed our internal benchmark, but broadly they've performed the way we would expect them to do in this kind of environment.
Sure. Okay. So I think perhaps just let me just share the key takeaway for our short update today. So our key takeaway is first, MYTHEO Omakase portfolio basically combine the three functional portfolio of growth, income, and inflation hedge that offer global diversification, and this help to protect against extreme fluctuation in any single asset class. And the inflation hedge portfolio, which predominantly invests in real asset ETF, has managed to outrun inflation and minimize the overall volatility of the Omakase portfolio. And at MYTHEO, we remain confident and convinced that the most effective investment method is to invest with a long-term perspective through our MYTHEO Omakase portfolio of growth, income, and inflation hedge portfolio. So today we will come to an end of today's short update session. So we will do this session monthly, so that our investor, you can hear from us how our portfolio has performed and ask us any question that you may have. Once again, thank you for joining us. So thanks, Matt, for your explanation. So we'll look forward to see you guys again next month. Thank you. Thank you.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. MYTHEO is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, MYTHEO will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way MYTHEO optimizes your portfolio. The algorithm that drives MYTHEO's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision making. With MYTHEO, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What MYTHEO does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, MYTHEO's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.